Welcome back to the deep dive. Our mission, as always, is to take that stack of research you've got, all those dense articles, studies, guides, and really distill it down.
Yeah, into the actionable knowledge you need to, get ahead faster.
And today, wow, we are tackling something huge. Maybe the single biggest source of financial anxiety, I think, for so many American households. Credit.
Oh, absolutely. Credit cards specifically.
Exactly. If you grew up here, chances are you heard that warning, right? Maybe from parents, grandparents, often with this, tone of actual fear.
Mm-hmm. Don't touch credit cards. They'll ruin your life. That old chestnut.
It's so pervasive. And it's created this massive blind spot, hasn't it, for generations of people who are otherwise really smart, really disciplined.
It's just a self-limiting belief, basically.
Yeah, totally. But the sources we're diving into today, they acknowledge that fear, that history, maybe even that trauma.
But they force you to look at the paradox.
Yes, the paradox, that these same tools, these things we're told to fear, credit cards, when you actually understand them, when you use them right.
They're the key. They're precisely the tools you need for financial freedom, for building real generational wealth, for getting funding.
Things that just paying with cash, well, it just can't do.
It simply can't build that kind of profile.
So this deep dive is based on this fantastic guide, really action-oriented, designed to just systematically tear down 10 of the most common credit myths.
Replacing that fear with, truth and strategy and confidence, hopefully.
That's the goal. And the core idea, the thing we have to internalize right now before we even start.
It's simple, but kind of revolutionary if you've grown up with the fear.
Credit cards are neutral, just tools.
Exactly.
Yeah.
They are not inherently bad debt, the power, and the danger too.
It's all in how you use them, the technique, not the tool itself.
Right. It's time to move past the emotional baggage. We're looking at a system built for leverage.
And this guide lets us approach it clinically, almost, like an engineer looking at a machine.
Yeah, if you want to shift from just being a consumer to actually building wealth, you have to stop seeing credit as like a morality test.
And start seeing it as, what? A performance metric.
A performance metric, precisely. You need to understand the rules lenders use, how they judge your access to capital. That's the game.
Okay, so let's unpack this. Before we get into the tactics, the playbook, we got to address the root. Why does credit have such a bad rap? Such a, toxic reputation for so many?
Well, our sources trace it back pretty clearly. It's often rooted in financial trauma.
Trauma, like personal experience or watching others.
Both. Equating credit with chaos, maybe uncontrollable spending, losing control of your financial life.
And sometimes that trauma is justified, right? Maybe personal mistakes, maybe predatory lending in the past.
Oh, definitely. The history isn't always pretty, but to move forward, you have to separate the user from the tool, the utility of it.
Which brings us straight to myth number 1. Let's hit it head on.
Credit cards are bad debt. This is the big one, the core psychological block.
And the truth.
The truth is, like you said, they're neutral. They're just revolving lines of credit, an agreement for temporary, unsecured borrowing. That's it.
So it's not the card.
It's bad behavior that creates bad debt, not the piece of plastic.
Meaning using it to fund a lifestyle you can't actually afford.
Exactly. If your spending outpaces your income and you're using credit to fill the gap, that's bad debt, no question.
But the flip side.
But if you're using it strategically to manage cash flow, maybe optimize rewards, build a perfect repayment history.
Then it's actually a wealth-building tool.
Factually, yes. It provides access to leverage, to capital in a way cash never could. It builds your financial reputation.
And that reputation, that credibility, that's where the FICO score comes in, right? Using cards responsibly feeds the beast, so to speak.
It absolutely feeds the beast.
Yeah.
And you need to understand how it feeds it. What parts of the score are most affected.
Okay, break down FICO for us. It's not just one number, is it?
Not at all. It's 5 core components. And credit cards directly, decisively impact 3 of them and indirectly influence all 5. It's central.
Okay, laid out. What's the biggest piece?
The absolute king is payment history. That's a massive 35% of your score.
35%. Just for paying on time.
Just for paying on time every time. It's non-negotiable. Credit cards, because they have that monthly cycle, build this history reliably, quickly.
But one slip up.
One 30-day late payment can tank your score. It can undo months, sometimes years, of good behavior. It signals risk immediately.
Wow. Okay, 35% for payment history. What's next?
Next up, Almost as big is utilization ratios. That's another 30%.
Utilization, that's how much of your available credit you're actually using at any given time.
Exactly. Total balance owed divided by total available credit limit across all your cards.
And responsible use helps this. How?
Because responsible use, paying on time, often leads to credit limit increases over time. More available credit automatically lowers your utilization ratio, assuming your spending stays level.
Okay. So higher limits are actually good as long as you're not using them irresponsibly.
Precisely. Lenders want to see that ratio below 30%. That's the standard advice.
But the real pros,
Yeah.
the people really maximizing their score,
They aim lower, much lower, under 10%. And we'll get into how you do that without paying a dime in interest later. It's a specific technique.
Okay, so payment history, 35%, utilization, 30%. That's 65% of the score right there. That's huge. That dictates mortgage rates, business loans.
Car loans, insurance premiums, sometimes even renting an apartment. It's foundational to your financial life.
What makes up the other 35%? Do cards play a role there too?
They absolutely do. Next is length of credit history. That's 15%.
So how long you've had credit accounts open?
Yep. It's the average age of all your accounts, and the age of your oldest account is particularly important. Lenders like stability, longevity signals that.
Okay, so closing old cards might feel tidy, but it hurts you here.
Big time. We'll circle back to that specific myth. Then you've got credit mix, which is 10%.
Mix, meaning different types of credit.
Exactly. Lenders like to see you can handle both revolving credit, like credit cards, and installment loans, like a car loan or a mortgage. Having a couple of well-managed cards helps this mix.
And the last piece?
The final 10% is new credit. This looks at how many new accounts you've opened recently and how many inquiries or credit checks have been run.
So applying for a bunch of cards at once is bad news.
It can ding your score temporarily, yeah. It looks like you might be desperate for credit. Strategy is key when applying.
So looking at that whole picture, 35, 30, 15, 10, 10, 10, the credit card is woven into almost all of it.
It's the single most powerful tool you have for actively building and managing that score, period.
Okay, that FICO breakdown is crystal clear. But let me push back slightly on the psychology again. I remember getting my first card with a, decent limit. And that feeling, it felt like permission. Permission to spend money I didn't technically have at that exact moment. Which leads us right into myth 10, the other side of the psychological coin. Credit cards make you overspend.
The impulse buy amplifier.
Exactly. How do we fight that feeling? The idea that the card itself is the trigger.
You fight it with data and discipline. The card, again, it's just a scapegoat for habits that were likely already there.
So if you overspend with cash, you'll overspend with credit.
Pretty much. The core truth our sources hammer home is financial habits outweigh financial tools. The card just makes overspending easier if the lack of discipline already exists.
So the solution isn't cutting up the cards.
No, the solution is control, visibility. You need a rock-solid spending plan first off. Know where your money should be going.
And then track it relentlessly.
Relentlessly. Set up alerts. Not just for the 30% utilization threshold, but maybe for 10%, even 5%. Know when you're approaching your budget limits before you blow past them.
Reconciliation.
Yeah.
Checking transactions daily or weekly against your plan.
Yes. You have to build that mental link. You swipe the plastic, but you need to feel the cash leaving your account. Mentally, at least.
I remember having to consciously build that connection. It wasn't automatic at first. It felt like free money until the bill landed.
That's the hurdle. But thankfully, technology can really help bridge that gap now.
Like budgeting apps.
Exactly. The guide mentions tools like Experian Boost, though that's a bit different. Boosting score with utility bills, but more like Mint, Credit Karma Money, tools like that.
How do they help with the spending aspects?
They integrate everything. You link your bank accounts, your credit cards. You see transactions in real time. You see your spending categories. You see your utilization instantly.
So the card stops being this silent temptation.
And becomes a visible part of your overall financial picture, tied directly to your budget. It turns the card into a budgeting ally if you use the tools right.
Okay, so wrapping up this first section. The real barrier isn't the technology of the card. It's psychological, the fear, and it's behavioral, the discipline.
Conquer those two, and you're ready to actually use the tool effectively.
Right, so we've hopefully shifted the mindset a bit. Cards are neutral. Our behavior is key. Now let's get practical. Actionable steps. How do you actually use this tool to get all the benefits, the points, the protection, the score building without paying the penalty?
The penalty. Interest. That's the goal, right? Use the tool, get the perks, pay zero interest.
Exactly. And that starts by challenging another one of those deeply ingrained beliefs. It sounds so responsible on the surface, but it holds people back.
Let me guess. Myth 2. You should never use credit if you have cash.
That's the one. The cash is king, pay your way mentality. Why is that actually, well, not the best strategy?
It feels safe, right? But it's financially short-sighted for one simple reason. Cash transactions are invisible.
Invisible to who?
To the credit bureaus, to the lenders. Cash involves no borrowing, no repayment, so there's nothing to report. You're basically off the grid financially speaking.
So you're trading that long-term reputation, that creditworthiness.
For short-term convenience, the superior strategy, the truth here is use credit, pay with cash flow.
Explain that. Use credit, pay with cash flow.
Think of your credit card like an intermediary, a temporary invoicing system. You use the card for the transaction because it offers benefits cash doesn't. Rewards points, purchase protection, maybe travel insurance, easier tracking.
And crucially, it gets reported to the bureaus.
It gets reported as positive activity, assuming you pay it off. Then, you use the cash you already had budgeted for that purchase to pay off the credit card balance.
So you're still only spending money you actually have.
Exactly. You're just changing the method of payment to capture the benefits and build your credit file.
You get free perks and build your score just by routing the payment differently.
That's the essence of it. Credit builds credibility for the future, cheaper loans, better opportunities. Cash just buys convenience now.
Is there a trick to the timing of the payment?
Yes. Critical detail. To really nail this and avoid interest, you ideally pay off the balance before the statement date even reports to the bureaus.
Before the statement closing date, not the payment due date.
Preferably, yes. If you pay it down before the statement closes, it often reports a zero or very low balance for that cycle. This keeps your utilization score factor super low.
And you still get the perks, the points.
Absolutely, and you've essentially used the bank's money, interest-free, for potentially 20 to 50 days, depending on your billing cycle and when you made the purchase.
That's powerful, using their money for free while building your score.
That's the game when played correctly. Which leads us directly to the fear that stops people even trying. Myth 8. Interest rates make credit cards worthless.
Right. You see those crazy high APRs, 20%, 25%, sometimes higher, and it just terrifies people. Understandably so.
It is scary if you plan on carrying a balance. But for the disciplined user we're describing, the one paying with cash flow,
that APR is irrelevant.
Functionally irrelevant. The truth is, interest is optional for the responsible. If you are paying interest consistently, you are, frankly, using the card wrong. You're not following the strategy.
How does that work, the grace period?
Exactly. Every card issuer is legally required to give you a grace period.
How long is that usually?
Typically 21 to 25 days. But here's the crucial part people miss. It's calculated from the statement closing date, not from the purchase date.
Okay, unpack that. Statement date versus due date.
Your statement date, or closing date, is when the card company totals up your charges for that billing cycle and generates your bill. Let's say it's the 5th of the month.
Okay.
Your due date is when the payment for that statement balance is actually required to avoid penalties. That might be, say, the 30th of the same month.
So the time between the 5th and the 30th, that's the grace period.
That 25-day window, in this example, is your grace period. If you pay the entire statement balance in full by the due date, the 30th...
No interest accrues, even if the APR is 25%.
Zero interest accrues on those purchases. That 25% APR simply never gets applied. It only kicks in if you carry a balance past the due date.
So all those perks, the cashback, the rewards points, the buyer protection, they become completely free.
Completely free. You leveraged the bank's money, got benefits, built your score, and paid nothing for the privilege just by paying the statement balance on time. This is fundamental.
Realizing that carrying a balance is a choice, not a requirement. That's a huge mental shift.
It's everything. Which naturally leads us to debunk another widespread, costly myth.
Let me guess. The idea that you have to carry a balance.
Bingo. Myth 4. You need to carry a balance to build credit. I hear this one all the time, often passed down like financial wisdom.
Yeah, let a small balance roll over. It shows you're using the card.
It's incredibly common and incredibly wrong. It costs people real money for no reason.
So the truth.
Simple and blunt. Carrying debt equals paying interest for nothing. You do not need to pay interest to build good credit.
What do the credit bureaus actually need to see then, if not a carried balance?
They need to see two main things related to your usage. Activity on the account, showing it's open and being used, and consistent on-time payments of at least the minimum due.
So just using the card and paying it off is enough. They don't need to see you paying interest.
Absolutely not. Paying interest is just giving the bank extra money. It doesn't make your score go up any faster or higher than paying in full.
Okay, but wait. If I pay everything down to zero before the statement even closes, like we discussed, for optimal utilization, does that look like no activity? Could that actually hurt me?
Ah, now you're asking the advanced questions. That's a fantastic point and leads to a more nuanced strategy.
Okay.
Reporting zero utilization across all your cards every single month can sometimes lead to what's called a silent file or score ghosting. The scoring models might temporarily not score you as highly because they don't see recent reported usage, even if you use the cards.
So zero isn't always the absolute best.
For optimal scoring, consistently reporting zero everywhere might not be ideal. This is where the sophisticated users employ a specific technique the source highlights.
Which is?
The AZEO method. It stands for all zero except one.
All zero except one. Okay, explain AZEO.
It's the advanced play for maximizing your score without paying interest. Here's how it works mechanically. You use your cards normally throughout the month, right, for your budgeted spending. But before the statement closing dates arrive, for almost all your cards, you pay those balances down to zero. So they report a $0 balance to the credit bureaus.
Okay, all cards report zero, except one.
Except for one designated card. On that single card, you intentionally let a small balance report on the statement.
How small?
Very small. Ideally between 1% and 9% of that specific card's credit limit. Not your total limit, just that one card's limit.
So if the card has a $5,000 limit, you let maybe $50 to $450 report? But probably closer to the $50.
Exactly. Maybe $50, maybe $100. Just a small amount that's more than zero, but definitely less than 10% of that card's limit.
Why does this specific small balance on just one card work so well?
It hits the sweet spot for the scoring algorithms. It shows two things simultaneously. One, you are actively using credit, so no silent file. Two, you are using an extremely small percentage of your available credit, demonstrating excellent, sophisticated control.
And this combination triggers the highest scores.
It often unlocks the very top tier of FICO scores, yes. Scores that get you the absolute best interest rates on mortgages, loans, saving you potentially thousands or tens of thousands over the life of a loan.
Okay, but hold on. This sounds like a lot of work. Paying off multiple cards to zero, timing it just right, leaving a tiny balance on one. Is the payoff really worth that effort compared to just using a debit card?
It's a fair question. Yes, it is undeniably more work than swiping a debit card. But the ROI isn't just points or miles.
It's the long-term cost of borrowing.
It's thousands, potentially tens of thousands, saved on major loans due to a top-tier credit score. That tiny reported balance on the AZEO card, say $50, even if you did somehow forget and pay a tiny bit of interest on it for a month, it would be pennies.
But the ideal is still to pay that $50 off during the grace period, too.
Absolutely. You let the $50 report on the statement, then you pay the full statement balance, including that $50, by the due date. The entire strategy remains interest-free.
Wow. So AZEO isn't about carrying debt. It's about strategically managing the reporting cycle to optimize your score.
You nailed it. It completely flips the script from carry debt to build credit to manage reporting perfectly to build credit for free.
That AZEO method detail is gold. Okay, so we've got the mindset, we've got the payment timing, we've got the advanced scoring tactic. Now let's zoom out a bit and talk about managing the whole portfolio of cards.
Right. Quantity, diversification, the age of your accounts. This ties directly into those other FICO factors we mentioned, length of history, credit mix.
Exactly. Which brings us to myth 3. Having multiple cards hurts your score. You hear this a lot. Oh, don't open too many cards. It looks bad. People panic if they have more than like 2.
Yeah, it comes from this place of fear, maybe fear of complexity or just this mistaken idea that lenders want super simple profiles.
In the truth.
The panic is completely misplaced. In fact, the opposite is often true, assuming good management. The truth is, it's not about quantity, it's about control.
So having several cards managed well actually looks good to lenders.
It demonstrates maturity. Sophistication. It shows you can handle multiple credit lines responsibly, juggle different due dates, keep utilization low across the board. That signals lower risk, not higher.
And how does it tie back to the FICO score factors?
directly into credit mix, that's 10%. Having multiple cards obviously helps diversify your revolving credit. But more importantly, it massively impacts utilization, the big 30%.
How does having more cards help utilization? Seems counterintuitive.
Because it increases your total available credit. That's the denominator in the utilization calculation.
Okay. Give us an example.
Sure. Let's say you spend $1,000 a month consistently on cards for rewards and tracking. If you only have one card with a $5,000 limit, that $1,000 spend puts your utilization at 20% right there.
Okay, 20%. It's
Right.
still under 30%, but not ideal.
Right. Now imagine you have, say, 4 cards, each with a $5,000 limit. Your total available credit is now $20,000.
Right.
That same $1,000 monthly spend,
Yeah.
now your overall utilization is only 5%. $1,000 divided by $20,000.
Wow. Huge difference. 20% versus 5%.
Huge difference in how lenders see your reliance on credit. High available credit with low usage is the goal. Aiming for maybe 3 to 5 well-managed cards is often a good target for diversification and utilization buffering.
But you mentioned strategy earlier. We shouldn't just go apply for 5 cards tomorrow, right?
Definitely not. That's where the new credit factor comes in. Apply strategically. The source suggests spacing out applications, maybe 90 days or even longer apart.
And choose wisely.
Choose cards that actually fit your spending, your goals, travel points, cash back, business expenses. Don't just collect plastic. Too many inquiries in a short period can temporarily lower your score. Be deliberate.
That links perfectly to the next myth, which is kind of the extreme version of the fear of having too many cards. Myth 6. Only one card is safe.
The minimalist approach. Keep it simple. Avoid temptation.
Yeah. But connecting this to the bigger picture, especially what you said about total available credit, why is limiting yourself to just one card actually, well, potentially harmful?
It hurts your leverage and, more importantly, your resilience. The truth is, one card limits your leverage and resilience significantly, especially when unexpected things happen.
Like emergencies.
Exactly. The source gives a really clear comparison. Let's paint the picture.
Okay.
Scenario 1. Resilience. You built up a portfolio, maybe 3 cards. Total available credit is, say, $15,000 across them all. You keep balances low normally.
Got it.
Then, boom, unexpected car repair, $1,500. You put it on one of the cards, your total usage just went up by $1,500, but across a $15,000 total limit.
So your overall utilization only jumps to 10%, $1,500, $15,000.
Exactly. Manageable. Your score takes maybe a tiny temporary dip, but recovers quickly. No major alarms triggered.
Now, the other scenario.
Scenario 2. Vulnerability. You stuck to the one card is safe idea. You have one card maybe with a $3,000 limit because you were cautious.
Okay.
Same $1,500 emergency hits. You put it on your only card.
Now, your utilization on that card and your overall utilization is $1,500 out of $3,000.
Yeah. 50% instantly. That's a huge red flag to the scoring models. It screams financial distress, even if you plan to pay it off next month. Your score could take a serious hit.
So multiple cards act like a buffer, a financial shock absorber.
Precisely. They spread the impact of any large, unexpected purchase, preventing those dangerous utilization spikes that can really damage your score and your access to credit when you might need it most. It builds redundancy.
Okay, that makes perfect sense. Now let's tackle another urge people have, often when they're trying to get organized or feel like they've made past mistakes.
The clean slate impulse.
Yeah. Myth 5. Closing old cards helps your credit. It feels so tempting, right? Especially unused store cards or cards from years ago. Just cut them up, close the account, simplify.
It feels tidy. It feels like taking control, but financially, it's often one of the worst things you can do for your score.
Why? What's the actual impact?
Remember that 15% of your score based on length of credit history?
Yeah, average age of accounts, oldest account.
The truth is the exact opposite of the myth. Age is a major factor in credit strength. Longevity equals stability in the eyes of lenders. Closing old accounts actively destroys that history.
So it shortens your average account age. What else?
It delivers what the source calls the double hit, because you're not just hurting your credit age.
You're also reducing your total available credit, right?
Exactly. You close that old card with its $5,000 limit, boom, $5,000 disappears from your total available credit.
Which makes your utilization ratio on the remaining cards instantly higher, assuming the same spending.
Precisely. So you damage the 15% factor, length of history, and the 30% factor, utilization, simultaneously, all for the sake of tidiness.
Ouch. So that old department store card I got in college and never use, Closing it is actually a bad idea.
A really bad idea, most likely. Unless it has an outrageous annual fee you absolutely can't downgrade away from, keep it open.
But what if the issuer closes it for inactivity?
That's the key. You need a retention strategy. Keep those old, valuable accounts active.
How do I need to use them regularly?
Not heavily. The simplest way is to put one small recurring charge on it, like a Netflix subscription, Spotify, a tiny monthly donation, anything.
And then set up autopay.
Set up automatic payment from your bank account to pay the full statement balance each month. That keeps the account active, reporting positive payment history, preserving that precious account age and available credit.
So don't cut them up. Put a tiny charge on them, automate the payment, and basically lock them in a drawer.
Let them age gracefully. They're silently working for that crucial 15% of your score. Don't sabotage your own history.
Okay, this is incredibly valuable stuff. Before we get into how the truly wealthy leverage credit, let's pause for a moment and talk about our sponsor, TONA Activewear.
Great idea. Because, just like mastering your credit takes strength and performance, you need gear that performs when you're hitting the gym.
Absolutely. And TONA Activewear is seriously premium stuff. It was founded by one of Lululemon's original designers, actually.
Right, and inspired by a competitive athlete's needs. So it's designed for gym women who are serious about their training. This isn't just about looking good, though they do.
It's about function. High-performance gear. They really are aiming to be like the last pair of black leggings you ever need to buy.
And you feel that in the engineering. We're talking moisture-wicking fabrics that actually work, four-way stretch that moves with you.
Yeah, total mobility, flexibility. Whether you're squatting, running, lifting, they stay put. They feel supportive.
The feedback is consistently amazing. Best leggings ever owned, never roll down, perfect for every workout, and durable too.
They really do feel like a second skin, but a supportive one.
Yeah.
Keeps you cool and dry, even when you're pushing hard.
And we have to mention the quote that just keeps popping up in reviews.
Oh, I know the one. It's like a push-up bra for my butt.
Haha, yeah. You can't ignore that. It speaks to that perfect combo of support, fit, and looking good while you perform. Function and fashion.
It really is the ultimate blend. You're investing in gear that's built to last and perform.
And they back it up. TONA has a 100% fit and happiness guarantee, so you can try them without worry.
Definitely check them out. We've got the highest exclusive discount code for our listeners. Use my personal promo code at checkout.
And just for transparency, we do get a small commission from that, but it directly supports the research and production that goes into making these deep dives possible.
It helps us keep bringing you this kind of detailed, actionable knowledge. So check out TONA, use the code, and let's get back to conquering those last few credit myths.
All right, welcome back. We are zeroing in on the final myths now. And these really get to the heart of how lenders see you and the difference between managing your own money versus managing borrowed money responsibly.
Yeah, visibility and leverage are key things here.
Let's start with one that seems logical but misses the whole point of credit building. Myth 9, debit cards build credit too.
Yes, I manage my checking account perfectly, that should count. Argument.
Oh, exactly. It feels like responsible financial behavior, so why doesn't it boost your score? It comes down to a fundamental misunderstanding of what credit scoring is. The truth is simple. Debit doesn't build credit. Period.
Why not?
Because debit cards use your own existing funds. You swipe, money moves from your account to the merchant. There's no borrowing involved.
You're demonstrating cash flow, maybe good budgeting.
But you're not demonstrating borrowed responsibility. You're not showing how you handle repaying money that isn't yours.
And the whole credit system is about assessing risk related to borrowing.
Precisely. With debit, there's zero risk to a lender because it's your money. Since there's no borrowing, there's nothing for the major credit bureaus Experian, Equifax, TransUnion to track or score in terms of creditworthiness.
So they only track things where money is lent and needs to be repaid.
Exactly. That means revolving credit, like credit cards and lines of credit and installment loans like mortgages, auto loans, student loans. Debit card usage, invisible to them.
So relying solely on debt keeps you safe from debt, sure, but it also keeps you invisible, financially invisible to lenders.
You got it. You could be the best budgeter in the world, pile up savings, but when you need a major loan for a house or a business,
you might have a thin or non-existent credit file, making it harder or more expensive to qualify.
Exactly. Safety doesn't equal leverage or opportunity in this system. You need to build that visible track record with credit products.
Which loops us right back around to the biggest fear of all. The ultimate scary story people tell themselves about credit cards.
The debt trap. Myth 7. Credit cards trap you in debt forever.
Yeah. This idea that once you start using them, you're doomed to this endless cycle of minimum payments and growing balances.
The fear is real, and for some people who misuse them, the trap can feel real. But it requires that crucial reframe we keep coming back to.
It's not the card, it's the behavior.
It's not the card, it's the lack of education and control. The truth is, discipline, not debt, determines destiny. Debt traps happen because of poor financial literacy, maybe impulse spending, and crucially, relying on minimum payments.
Ah, the minimum payment. That seems like the real villain here.
It absolutely is. It's designed to keep you paying interest for as long as possible. It's mathematically engineered to maximize the lender's profit if you only pay the minimum.
Can you illustrate that? Like, how bad is it?
It's shocking. Say you have a $3,000 balance. Not huge, but common. At a typical 22% APR, if you only make the minimum payment each month.
Which might only be like $60 or $75.
Right. You could end up paying hundreds, maybe even thousands more in interest than the original $3,000. And it could literally take you over a decade to pay it off.
A decade for $3,000.
That's the trap. Paying the minimum is like quicksand.
Okay, so avoiding the minimum payment trap is critical. But let's flip it. If you are disciplined, paying the full statement balance every month, how does the card transform? You use the word leverage. How does it become a line of leverage?
Leverage is the unlock. It's what separates basic consumers from strategic wealth builders. When you've managed your cards responsibly, maybe you have high limits now, but you keep your utilization consistently low under 10%, maybe using a ZEU.
You've built trust and capacity.
Exactly. You now have access to flexible, temporary capital. This isn't debt in the scary sense. It's a line of leverage you can deploy strategically for opportunities that maybe your immediate cash flow can't cover instantly.
Like what kind of opportunities?
Think short-term financing needs. Maybe bridging a gap for an investment, buying an asset quickly before someone else does, knowing you can repay the card from other funds shortly after.
Without having to drain your emergency savings or sell other investments prematurely.
Precisely. It provides liquidity and agility. Let me give you a concrete example, maybe for a small business owner.
Okay, yeah. Make it real.
All right. Say you sell seasonal products. A huge shipment arrives, perfect timing for the peak season. The supplier invoice is $10,000, due in 30 days.
Okay.
You have the $10,000 cash in the bank, but paying it immediately drains your operating cash for the next month. Maybe payroll's coming up, other expenses.
Oh, it's so crunch.
So instead, you put the $10,000 invoice payment on your high-limit business credit card that earns rewards. Step 1. You instantly get the points or cash back on that $10 spend. Bonus. Step 2. You use the card's grace period, let's say it's 21-25 days, to sell through a good chunk of that new inventory. Generating revenue. Before the credit card payment is due, you take the $10,000 from your sales revenue and pay the credit card statement balance in full.
So what happened?
You used the bank's money for free for 3 weeks. You earned rewards on the purchase. You generated positive payment history for your business credit. And you kept your own $10,000 cash liquid in your bank account the whole time for operational needs.
That wasn't incurring debt. That was strategically managing cash flow using the credit line.
That is strategic leverage.
Yeah.
You turned a potential cash flow problem into an optimized reward-earning, credit-building transaction.
That completely reframes the tool. It's not just a payment method. It's a flexible, potentially interest-free capital resource.
When used with discipline and foresight, yes. Instead of being trapped by debt, you're using revolving credit as an agile financial tool. That's the goal.
Wow. Okay, we have really spent this deep dive systematically flipping that script, haven't we? Moving from seeing credit as this, like, weapon of debt.
To seeing it as an instrument of opportunity, if you know how to play it.
Exactly. But just knowing the myths isn't enough, right? You need a plan, a structure, a strategy to actually achieve that mastery.
That's the final piece. You need the modern credit strategy, as the source calls it. It's a clear 4-step process. It's about moving beyond just avoiding mistakes.
Towards intentionally building wealth and freedom using the credit system.
Precisely. So step 1, educate. You have to know the rules of the game, maybe even better than the lenders themselves.
Meaning?
Know your credit mix. Understand those 5 FICO factors inside and out: 35% payment history, 30% utilization, 15% length of history, 10% credit mix, 10% new credit. Know how the algorithms think.
Knowledge neutralizes the fear.
And eliminates costly mistakes. Once you're educated, you move to step 2, strategize.
This is where things like AZO come in.
Exactly. You implement proven models. The source mentions things like a credit builder blueprint, likely a system for establishing or rebuilding credit. It emphasizes the AZO method we discussed for score optimization.
You also mentioned infinite banking earlier. How does that connect?
Yeah, the source links it. The infinite banking system, or concepts derived from it, when applied here, is about creating your own pool of capital you control. High-limit, low-utilization credit lines can become part of that accessible capital pool.
So using strategically managed credit lines as a component of your own bank.
In a sense, yeah. It's about converting borrowed capital, managed perfectly interest-free, into fuel for self-funded ventures or investments, maintaining an optimal profile you can tap into without relying on traditional loan applications every time. It's advanced capital structure management.
Okay, so educate, then strategize with specific methods requires discipline.
High discipline, which leads to step 3, leverage. This is where the real separation happens.
Between the average consumer and the financially free.
Pretty much. You take those high limits you earned through responsible behavior through low utilization.
And you use them not just for everyday spending, but for bigger things.
For genuine investment opportunities. For strategic travel hacking that saves thousands. For business expansion, like we discussed, using the line to acquire an asset quickly.
Bridge funding, inventory.
Maybe a down payment on an investment property you can quickly refinance, using the card's grace period to cover short-term costs. The key distinction: use credit to buy assets that appreciate or produce income.
Not just stuff that depreciates, like clothes or electronics beyond your budget.
Right. Use it for asset acquisition, primarily. That's the power move. It becomes a short-term, interest-free loan for growing your wealth.
Okay, educate, strategize, leverage. What's the final step?
Step 4, protect. You've built this incredible asset, your credit profile, and access to leverage. You have to guard it fiercely.
Like you'd guard your cash.
With the same vigilance. This means constant monitoring. Check your reports monthly, at least. Use fraud alerts. Scrutinize every single statement, catching errors, unauthorized charges, identity theft attempts early.
Immediately. Your credit reputation is like a second invisible bank account. Protecting its integrity is paramount for a responsible user.
These 4 steps: educate, strategize, leverage, protect, paint a picture that's radically different from how most people approach credit.
It's a stark contrast, isn't it? The average person maybe fears it, avoids it, or misuses it reactively.
Whereas the wealthy,
The truly wealthy, the financially sophisticated, they don't avoid credit, they master it. They understand it's the language of capital, of business, of growth.
they use those high credit lines differently.
As a ready source of liquidity, not as crushing debt. They maximize rewards as a secondary income stream on every dollar they spend anyway. They reinvest those returns. They understand the FICO algorithm intimately.
They're playing offense, not just defense.
Absolutely. They're using the system to their advantage legally and ethically because they took the time to understand the rules. Which really brings us to the core takeaway for you, the learner, listening to this. Credit literacy isn't just nice to have.
It's power. It's the divider between being financially fragile, always worried about the next bill or loan application,
And being financially free, having options, having access to capital on favorable terms.
Don't let those old myths hold you back. They cost you money. They limit your potential. The knowledge is out there. The strategies work.
And we want to leave you with this final thought, something really provocative from the source material that encapsulates this whole shift in perspective.
Yeah, this is the end point. The goal isn't simply to not fear credit.
The goal is to understand it so completely. The rules, the scores, the timing, the methods, like AZEO, the power of the grace period. Understand it so well.
That the entire credit system starts working for you. Building your score, earning you rewards, providing leverage, passively, almost automatically because you set up the systems correctly.
Building your financial strength even while you sleep.
That's the level of mastery to aim for.
Thank you so much for sharing these sources and diving deep with us today into really cracking the code on credit.
My pleasure. It's crucial information.
We really encourage you listening. Take this knowledge, apply the discipline it requires, and start actively shaping your own financial future using these tools strategically. We'll see you on the next deep dive.